Hello students, today we are going to learn the classification of accounts. This classification of accounts which we are going to learn is based on the English concept and is also the traditional classification of accounts. Accounts can be broadly classified as personal, real and nominal as per the English approach. Now, let us learn what is the meaning of each of these types of accounts. So first we are going to learn the meaning of personal accounts. Personal accounts are those accounts which relate to an individual firm, company, or an institution. Account of Ram, Kings and Company, account of DCM Limited, account of Delhi University, bank account, or capital account and drawings account of a proprietor all are personal accounts. Personal accounts can be further classified as natural personal accounts, artificial personal accounts, and representative personal accounts. Let us now learn what are natural personal accounts. Natural person means a human being. So, if the accounts are maintained by the names of natural persons, they are termed as natural personal accounts. You can see the examples. Mohan's account, Sohan's account, proprietor's capital account, proprietor's account, debtor's account, capital account. All are natural personal account. The next classification of personal account is representative personal account. Representative personal account represent a certain person or a group of persons. Prepaid rent account, accrued commission account, outstanding salary account. These are a few examples of representative personal account. Now, we have artificial personal accounts. These accounts include accounts of corporate bodies or institutions which are recognized as persons in business dealings. The account of a limited company will be an artificial personal account. Similarly, the account of a club or a cooperative society will also be termed as artificial personal accounts. So, we have learned that the personal accounts are those accounts which represent particular persons, institutions, or any representative persons. Now we come to the next category of accounts, and that is real accounts. All those accounts which can be measured in terms of money and which are properties of business are termed as real account. Example, cash account, furniture account, machinery account, building account, or goodwill account. Real accounts can be further classified as tangible real accounts and intangible real accounts. Tangible accounts are those accounts of things which can be touched, felt, measured, purchased, and sold, like cash, stock, building, furniture, and land. All these are examples of tangible real accounts. Intangible real accounts. Intangible means something which we cannot see, we cannot touch. So, those accounts which represent such things which cannot be touched, but of course their value can be measured in terms of money, are termed as intangible real accounts. The examples will more clearly explain intangible real accounts. They are goodwill account, patents account, trademarks account, and copyrights account. Now we come to the third category of accounts, and that is nominal accounts. Nominal account represents all the expenses and incomes. Example, commission received, interest received, discount received, commission paid, rent paid, etc. They are all examples of nominal accounts. Now, something important which has to be noted. When any word as a prefix or as a suffix is added to nominal account, it becomes a personal account. Suppose we have rent account. Rent account is an expense and hence it is a nominal account. But if we write rent prepaid, it becomes a representative personal account. Salary outstanding is also representative personal account as it represents the person to whom the salary has to be paid. If we just write salary, it is a nominal account because in that case, salary represents expense. Now, we come to the next part, that is golden rules. These are the rules of debit and credit. The entire accounting is based on these rules. So we have got 3 accounts and 3 rules for each of these respective accounts. The rule for the personal account is debit the receiver, credit the giver. I repeat it once again. The rule for the personal account is debit the receiver, credit the giver. The rule for the real account is debit what comes in, credit what goes out. I repeat, debit what comes in, credit what goes out is the rule for real account. The rule for nominal account says debit all expenses and losses, credit all incomes and gains. Again, let us see. Nominal account rule says debit all expenses and losses, credit all incomes and gains. Children, I would like to remind you that these rules are the basis of accounting. Hence, you must know them by heart if you want to do the accounting in a very easy manner. Now, we will take some transactions and see how the rules are applied. Suppose your transaction is Mohan started business with cash rupees 1 lakh. So when we have to debit and credit the respective accounts, first we need to identify which 2 accounts we will make. So when we look at this transaction carefully and on analyzing, we find that the 2 accounts that will be affected are cash account and capital account. The next thing that we have to do is to identify the types of these accounts. So, cash account is a real account and capital account is a personal account. Now that the accounts are identified and also the types of accounts are identified, we move ahead with the application of rules. So, cash account being a real account, we will apply the rule for the real account. and we will see what is happening with cash. So, the rule for the real account says debit what comes in, credit what goes out. Since cash is coming into the business in this transaction, it will be debited. So, cash account will be debited. Now, let us see what happens with capital account. Capital account is a personal account. It represents the person or the proprietor who has invested money into the business. The rule for the personal account says debit the receiver, credit the giver. Since Mohan is the giver of capital and capital account represents Mohan, it will be credited. So, I hope that this transaction has explained you clearly why we debit a particular account and why we credit another account. Moving ahead, let us have one more example. Purchase goods for cash rupees 25,000. We will follow the same steps, that is, identification of two accounts. Then we will try to find out what are the types of accounts, whether they are real, personal or nominal, and then finally we will apply the rules. So when we are purchasing goods, we will make purchases account and cash account will be there as a second account because we are purchasing goods for cash. Next, we will identify the type of accounts. So purchase account is a nominal account, whereas cash account is a real account. We will apply the rules according to the types of accounts. So nominal accounts rule says debit all expenses and losses, credit all incomes and gains. Purchase is an expense, hence it is a nominal account. So it will be debited because when we are purchasing, the expense is increasing. An expense is there, so it will be debited. Cash is a real account. The rule for the real account says debit what comes in, credit what goes out. In this transaction, cash is moving out of the business. It is going out of the business and hence it will be credited. Let us take one more example. Purchased furniture for cash, rupees 10,000. Children, now be very careful. In the previous transaction, we were purchasing goods. And in this transaction, we are purchasing furniture. So the two types of accounts which are identified are furniture account and cash account. The types of accounts are furniture is a real account and cash account is also a real account. So we will apply the rule for the real account. Debit what comes in, credit what goes out. So which item is coming in? Furniture is coming in. So it will be debited. And cash, since it is moving out, it will be credited. I hope you have understood how we apply the rules. So, the more you practice, children, the more master you will become in accountancy. Let us recapitulate what we have learned today. We have learned that there are three types of accounts as per the English approach or the traditional classification. And these accounts are personal, real and nominal. The rule for the personal account is debit the receiver, credit the giver. The rule for the real account is debit what comes in, credit what goes out. And the rule for the nominal account says debit all expenses and losses, credit all incomes and gains. With the hope that you have learned the lesson, I end it. Please go through it again and see that you have learned the types of accounts and the rules which are applied to them. Thank you.